Hello, and welcome to our first in a series of discussions about private equity investment in professional services firms. There is so much discussion in the media and online about private equity investment in professional services firms and particularly law firms. I mean, who isn't these days getting an email saying, would you be interested in having a discussion about private equity investment in your firm? Certainly, we're getting them sort of almost daily, to be honest. So we just thought this would be a great opportunity to have a discussion between us with our partner, Corinne Staves, who's one of our brilliant partnership experts, and also in future episodes with our partner, Zulon Begum, who's head of our partnership practice, and our regulatory partners as well, to sort of bring in some of the different aspects in this topic. So, Corinne, the phone rings, and it's someone from, insert name here, private equity fund, saying, Claire, come on, wouldn't you like to have a chat? Should I take that call? Or should I just say, thank you very much? That just doesn't fit with our plans or our culture. As an advisor, what would you say?
I think as a lawyer, I'd say it depends. No, I think it depends on what strategically you've already decided that you're thinking about. I think that you should definitely be thinking about taking the call, certainly, but I can't answer the question of whether you should take the call or not, or whether you should seriously entertain those discussions until we sort of step back and gone, actually, let's have a think here. What are you and what is the firm trying to achieve strategically? What's our 5-year plan looks like? What's our 10-year plan looks like? How are we going to achieve that? Can we supercharge that by, for example, having external investment? If we do want external investment, can we do that by putting our hands in our pockets and providing that finance ourselves? Can we go to the bank and therefore not have to hand over that control and that sort of influence of an external investor? Or actually, do we want that external influence? Do we want someone to step in and say, actually, I'll run this, I'll offer this kind of new technology platform, I'll offer this upgrade, I'll offer you economies of scale by the sort of the growth of the business, and actually I want you to focus on your clients and delivering that strategy. So really, Claire, I know it's a bit of a non-answer, but it sort of depends what your thinking is on strategy. And I know you're not in this boat, but I think for a lot of managing partners there might not be that clarity of thought around what the firm's strategy is and what the aims are for the short, the medium and the long term. And if that's missing in a managing partner's playbook, then they need to deal with that first of all before they take that call.
Great. So I'm open-minded now about taking the call.
Absolutely.
Obviously, our firm, like many others, are very focused on growth. Kind of client-led growth, but for growth in sort of revenue, profitability, and headcount, and in the services that we offer to our clients. On that basis, with that kind of growth mindset, do you think this is likely to be the thing to consider actively?
I think it could be, to be honest with you, because when you hear PE houses are talking about the attraction that the legal services market holds for them, they see the opportunity to help firms to grow as really where the value lies, because it's expensive and time consuming to build out your businesses. And that's not some weird intangible concept. We're talking here about bringing in new partners, bolting on new practices, joining forces with other firms, for example, as sort of a strong and active acquisitions strategy to sort of build out the firms, to complement the existing strength and to build the strengths that you've identified as market opportunities. So PE see these opportunities and they're willing to invest, because that takes time and that takes money. They're prepared to back that and put capital into the hands of the firms to do that.
When the PE firms come in to a professional services firm, who is then going to be leading that firm going forward? Is it the existing management team, or will the PE people be bringing in their own people onto the board and just basically running it for you? What is it that PE firms expect in that regard, and what should law firms anticipate?
Again, another great question, and I think it really does depend on the structure of the deal that you're kind of considering as a firm. There are sort of two ways in which you might accept private equity investment. You might be the first firm, if you like, that the house has approached. So you're kind of the starter firm, the central firm. Or you might be approached by another firm that's already accepted the private equity investment. So they've created already the platform, and you might be sort of bolted on to that platform. And I think in the latter case, it's slightly more straightforward in the sense that that framework, that structure already exists, and you bolt in. I think in both cases, there's a recognition that the firms have strong leaders. The partners will, for example, always manage the client relationships, look after the teams. However, I think if you talk to the managing partners of firms that have accepted private equity investment, they will talk about the dialogue they have with the private equity house and sort of meeting the objectives that they've been said. I think the private equity houses will say that they have a sort of a very sort of hands-off approach in the sense that they set the deliverables and they expect management to do it. I wonder, as we see some of these transactions play out, those that are successful, I'm sure the PE house is very happy to leave the management team just to get on with it. I suspect that if either the growth that they're driving towards is not being delivered at the rate at which it's expected, or perhaps there isn't a success there that was expected, then I imagine that there will be a more active dialogue. And I think constitutionally, we need to accept the reality that PE will have a significant influence from a technical sort of voting and control perspective.
And then I suspect you'll also need to be clear with the private equity investor that your idea of growth in your strategy actually aligns with their idea. You may have X million growth in your plan, but they may have a significantly larger growth trajectory than you're aware of. Is that something that you would expect?
I don't know that I would, Claire, because I think that there will be incredible transparency about the expectations on the firm. So, for example, you might have a certain growth objective for the firm that you start with, but the PE house might say, for example, well, actually through our sort of buy and build strategy, you're going to add in new practices and you're going to grow exponentially, perhaps, but not because we expect you to work 17 times more hard, because the firm's going to grow so hugely through aggressive lateral hiring or sort of merger and consolidation and acquisitions. So that's where we might see a disparity. I don't think we would see transactions where there is just a fundamental misunderstanding about the expectations of the PE house and the underlying businesses, because that's a fail right there, isn't it? Everybody has to be working towards the same objectives. I would say it might be more interesting where you see sort of the secondary transaction. We talk about the exit here, and the likelihood is that if you take PE investment for the first time, the PE houses will have a very different approach. But I think sort of between 3 and 6 years later, maybe 4 and 7, the PE house is going to be looking to make its exit. And the likelihood is that another investor will come in and sort of buy out their stake and sort of drive the second phase of growth and so on. And because it is likely that the first PE house will have the decision-making power about that sale, then what influence does the firm have over its choice of its future investor? I suspect that's negotiated on a case-by-case basis, and I wonder whether there's more scope there for mismatches, because you wouldn't go for it in the first place if you weren't confident. But I wonder with those secondary transactions whether there's more scope for misunderstanding or misalignment. Again, I may be wrong. I hope I am, but I guess that's, I think, where the risk lies more than the first time round.
And are all private equity houses equal? Are they all the same? Presumably there's quite a lot of due diligence that you as a firm, if you're actively considering this as an option, you actually need to understand what each private equity firm offers and their cultural approach and their plans.
I completely agree. I don't think they are all equal. Far from it. I think you'll see some really different approaches in terms of the capital that's available, the strategies that they have, the way in which they want to see things evolve. Gladly, the legal services sector has got the example of the accountancy sector, which is sort of a bit further advanced, I think, possibly than the legal sector, to sort of see what sort of track record some of these investors have. Some are just sort of entering the market for the first time. I think that will be quite helpful. I think, again, that goes back to the firms understanding what they want. Do they want that strong management influence? Some firms may well want not just the capital, but also that management and that sort of strategic input that perhaps is lacking. Other firms might be very confident in that aspect, but need the capital to do it. You will hear PE houses, as I say that they're very happy with a hands-off approach. And I guess that's something that you You also have to test in your discussions. People will say things, and then you've got to take a view, don't you, on whether you believe that that's the way they operate. But the process of agreeing heads of terms and negotiating points and working out what it's going to look like on the other side will give you a really good sense, I think, of the people that you're operating with, and what their expectations are, so that you can make an informed decision about whether it works for you in the business.
Just looking forwards, what would the private equity investment actually mean to a firm, whether it's a mid-sized firm or say a boutique firm like ours? What would it mean for the partners in the firm and the business itself?
I think that's a really important thing for firms to think about. Are you the first firm, sort of the lead firm, that's going to be sort of leading on this, or are you joining an existing PE-backed platform? And that will depend quite a lot. I think in the latter, the change will probably be less significant, probably because that framework is already there. But in the first case, then you need to create the framework, the systems, the processes, the strategy to sort of to be the firm that's out there and buying up new firms and so on and so forth, assuming that's part of the strategy. So sort of how you're doing this will be really relevant to that question. In either case, I think what you will perceive as a difference to the pre-PE period is that there'll be dramatic investment. I think that it will be much faster than anything that law firms have generally experienced. I know there are some really ambitious, really driven firms, but I think we can generalize and say that the pace within law firms is not the same that you see in the PE-backed world. So I think we'll see much more investment, fast investment growth. You might see, for example, really quite ambitious partner admission timetables. You'll see sort of lots of acquisitive activity, for example, at a pace, as I say, that you might not have seen prior to the investment date. I think you're going to see greater drives towards efficiency, so greater adoption of technology, whether that's, for example, either updating existing technology offerings or adopting new platforms, whether it's practice management systems to CRM databases. And I think that's also because that's going to support the BD, the workflows, the cross referrals, and making sure that the whole network is then driving towards building out that complete firm that's being built and that's growing. I think there's going to be a lot greater focus on deliverables, on targets. Obviously, a lot of the evidence we have is anecdotal that the regime is much more targets focused. Again, I'm not saying you can't have that in a traditional law firm environment, but people describe it as a difference. So I think that perhaps there is a greater pressure on delivery than you might see in a traditional law firm. Again, that's firm to firm, not necessarily. I think a really key thing for the partners to bear in mind is that they're swapping here from a model where they are likely to get full income each year in the form of a profit share, usually, to a model which is you get your income during the year, perhaps a salary, a healthy salary, maybe a bonus if you're performing well against your targets. But the principle here is that the growth is going to be reflected in some kind of future capital event. So you are effectively investing for a future capital return, and therefore your bumper compensation, if you like, comes at key capital moments. For example, the exit at which you would hope to benefit at the same time. I think technically that might mean that company structures are favoured over LLP structures. We'll have to say how that works out. Obviously, not all PE structures have moved to companies, but I think there's a possibility, particularly in those sort of bolt-on type scenarios where the existing structure is one that is imposed on the firm. So in that circumstance, the firm will need to think about, does that affect things like the culture and the attitudes of partners and how they feel within the firm, and making sure you preserve those elements regardless of the legal structure you've got.
Yeah, and I guess whether they still retain that sense of ownership and engagement and entrepreneurialism.
Yeah. Absolutely. And hopefully, Claire, actually, it would go further than that. And again, we're talking here about a really successful situation, but the existing partners would maintain that sort of sense of ownership. But hopefully this structure would also enable for the next generation of people coming through to have an element of ownership, perhaps represented in an equity stake for senior employees or senior business support teams that don't necessarily always get an opportunity to share in the equity of the business. So kind of done well, you can see how everybody can be incentivized and energized as owners of the business, driving its success.
So I'm interested as to the type of concerns and objections, though, that some of the other partners in the firm, especially some of the younger partners, might have to private equity investment. They might see the older generations like me as basically selling off the family silver and, potentially cashing out. and undermining the culture of the firm in which they've kind of invested a lot of time and energy. So I'm just interested, I guess, what are your thoughts about that, and what do you hear from partner groups around those sort of issues?
It's a really interesting question, and I think there is a kind of rather lazy idea in the market that an external investor will come out and effectively provide an alternative for people who failed to do proper succession planning within their businesses. They'll sort of write a check and then you can just walk away having banked a capital value for a business where you've had full income throughout. Like all things, an external investor will look very carefully at the economics, and if there isn't value there represented by the business, the clients, the future leaders, then that check's not going to be a very big check at all. If that's your objective, I think that there is a delicate balance though, because there are tensions between the different generations of partners across the business. Often the equity partners will have the largest investment in the firm in terms of capital, voting rights and so on, so they may be the decision makers about whether or not to go for it. Sometimes the junior partners do have a vote, sometimes they're consulted, sometimes they're not, and so sort of managing those tensions is really interesting. You also sometimes find that the people who have the most senior stake have the most equity, therefore they get the kind of the greatest return from the proceeds and from any sort of deferred earnouts and so on. But it's usually the junior partners who have the longest lifespan within the firm and the future firm, so you've got to make sure that it works for them, or that there's a really compelling offering for them. Now, I'm sure if you talk to a PE house about this, they would say that actually the annual compensation and bonus opportunities were more than enough to sort of be an equivalent to the profit shares that these partners are enjoying, and then you enjoy this capital value. And really, it's going to come down to whether that's convincing to the junior partners, whether they're looking at the model and saying, well, actually, this is achievable, we can do this, I feel excited about this new model, or whether they go, well, actually, no, I've always wanted to be equity partner, I've always wanted to own a firm, this is not for me, I'll be gone in a year and a half's time. And who knows what mentality, which again is where leadership comes back in. So the managing partner really needs to know early on, where are the partners at? What are they thinking? If this is what we're doing, who's going to stick, who's going to twist, and have a true understanding of the dynamics across the partner body.
So a clear strategy, and also very, very good and consistent communications. In both directions, not just transmit. Just saying. So I'm taking the call, right? Like any other good managing partner, I'm taking the call. I'm listening.
And then you've decided you can take the call.
Oh, hang on. Do I have to talk to you all before I take the call?
Right? You've just said hearts and minds. So they go, this seems fun. What do you reckon? We'll go, yeah, sounds interesting. And then you take.
Okay. So then there's a collective interest, say, in the opportunities that this, alongside other options, might bring for growth, for really good, productive, long-term growth. What should I and other managing partners be thinking about to sort of rapidly get our house in order, be in a position to have meaningful discussion?
I guess I would say it's the same as any other big strategic decision, whether it's a merger, whether it's, for example, an acceptance of loads of lateral partners, for example. You need to think about what you're trying to achieve. You need to understand, and back to that point about, do you know what your strategy is? How do you achieve it? Because then when you do take the call, then you can test what's on offer and what the opportunities are and what options there are against what you're trying to achieve and what delivers what you consider to be success in your business. I'm not saying don't be open-minded about other opportunities and success routes, but I guess you fundamentally need to know what you're hoping to get out of this conversation, out of this potential transaction. If you don't know what that is, then how can you know if what's on offer is a good offer? So that's really important. It also enables you to be able to walk away from those conversations quite quickly, because this call might not be the right person, but the next person might be the right person. So you know when you can walk away if it's not right, and that you can fail fast is a really good motto, isn't it? I also think that understanding what you're trying to achieve gives you real clarity on the other side in terms of while you're implementing this new structure, how do you know what success looks like? Well, then you'll have measurable objectives where you can say, right, here are our milestones. This is what we need to achieve. This is how we know that we are heading in the right direction at the right pace. On a practical level, there's quite a few things the firm probably needs to deal with. Fundamentally, dealing with the skeletons in the closet, because you're going to engage in a process of due diligence with this firm. skeletons in the closet could affect price, which is unpleasant. You want to sort of really improve the consideration. And also, I would say that these are good housekeeping things that all firms should be doing anyway.
What would these skeletons be?
Yeah, great question. Well, things like legacy costs, things that you're paying for that a buyer might not necessarily want to take on. For example, annuities to former partners. Have you got any kind of like pension deficits that are sort of lingering in the background? Have you got any weird arrangements where former partners had stakes in underlying subsidiaries and therefore they've still got interests in the business, even though they're now former partners? That comes up more often than you'd expect. Property sometimes comes into that. Think about your risk profile. Where are your key risks? Do you understand your key risks? Look at your claims history. Look at any ongoing disputes. Think about it in a very cutthroat way. You might, for example, have a dispute with a former team member. You might, if you think about it in a very emotional way, you think, no, we want to sort of continue to engage with this dispute because we kind of disagree with what this person is saying. But a more cutthroat person looking at it in a pure cost benefit sort of side of things might just say, settle at X price, make this go away. So sort of thinking about things in a slightly different way might be helpful. I think a really difficult one for firms to address, but really important one, is underperforming partners and underperforming teams. That might be the partner's fault because they're just not delivering at the level that's needed, or it could be the fault of the market in the sense that that's just not strategically an area where the firm is going to drive success. And that might be really sad because you really like these people, but that's a commercial reality that you've got to grapple with, and your new owners will definitely make you grapple with it. You as a business should have already grappled with it. Other costs, things like archived files, for example. That's a horrible thing. It's difficult to deal with. You're paying your storage costs ad infinitum. Nobody wants these old bits of paper from 25 years ago with matter partners listed that left 20 years ago. Deal with that. Deal with it now, because a merger partner, an investor, does not want that ongoing cost in your accounts. Same with sort of property costs, long leases, things like that. I mean, people talk about sort of selling their wills bank as an asset, but actually that's actually a headache of SRA issues. You've got to get client consent to be able to sort of to transfer that business and to sort of to deal with those things. So do you even know whose wills you hold in your will bank? You need to at least have a list of those sorts of things, and you'll be surprised how many times firms don't even have basic information about what data they hold, let alone whose consent they need to transfer it. And then I think the last thing is a bit more woolly, but I think if you've got partners with grumbles, you need to deal with that, because whether they're legitimate or not, you'll always have a partner who's got beef about not having a corner office, or not having a coffee machine near where their desk is, or the flexible working policy, whatever it is, and they will use those existing grumbles to visit them on the management, perhaps withhold their votes, perhaps kind of cause issues. Therefore, if you've got any of that tension within the business, get it out in the open, deal with it, because it's not going away. You need to deal with it. You should deal with it anyway, but this could be a useful catalyst to get those things dealt with.
Okay, great. Those are really great practical things. Although, they don't sound like quick things to solve, and the conversations with the PE houses may go more quickly, but I totally hear that in an ideal world, I or any other owner of a firm would be addressing those things as quickly as possible.
Yep. I mean, apart from anything else, Claire, even if you stay entirely independent and you just want new partners to come through organically, they still care about stuff like that. This is, however you look at it, deal with this stuff. Don't let it fester. It would be the advice.
So, what about international firms? I mean, is private equity investment open to them? Is that sort of structurally, I guess, regulatory perspective? Is that an option for them?
I think it is, Claire. Yeah, absolutely. I mean, we look at international firms, and what do they represent? Well, they represent a great diversification of your practice. So protection against risk, against dips and peaks in the market. So I think it's a really healthy part of any firm's strategy. I think if we're thinking about it from the perspective of external investment, then one of the key issues is whether or not the jurisdictions we're talking about welcome or permit the influence of non-lawyers on the business. There are a number of key jurisdictions where they don't. So that's something that really has to be grappled with. The US is a really key example, but we've seen with the KPMG decision in Arizona relatively recently that the door is starting to open a little bit. So it will be fascinating to see how that evolves over time. Certainly in the UK, we've had the opportunity for external investment and influence over law firms since the Legal Services Act for decades now, and we haven't all ended up sort of dropping our ethical standards or anything. So it's in principle, it's not a disaster for the ethics and the independence of the profession, but obviously not all countries see these issues in the same way. What I would say is that international law firms grapple with these issues all day, every day, and the structures that they have in place manage them appropriately. You can't practice in those countries unless you're completely compliant. So there are ways and means of creating structures that permit firms to operate with different regulatory regimes in different countries, and they thrive despite those regulatory constraints. And I think the same is true here. You just need to think about the structure that you have, the way that the investment is deployed, the influence within the organization. So I think it will make life more complex. Yes, of course, but I don't think it's insurmountable. No, and I don't think PE will at all see that as a barrier.
And finally, what if I don't take the call on the basis that, I don't think anyone's going to be interested. I think it's countercultural for us. I guess, what are the risks in not at least exploring it?
Every firm is going to decide whether or not this is a good option for them, or whether it's something that they need to explore. But even if as a firm you decide it's not for you, it doesn't suit your culture, it doesn't suit your strategy, you can't ignore the fact that PE is here. And I think its influence over the legal sector is going to be bigger and bigger. I mean, again, let's just look at the accounting sector. The investment into the accounting sector is bigger and bigger, and it is not the periphery. Grant Thornton, it took a huge private equity investment at the end of last year. There are other big examples too. This is here to stay, and this is the competitive marketplace in which we are all operating. So ignore that at your peril. I'm not saying that we can't compete against PE-backed firms, far from it, but we need to think about how that competitive market is changing. For example, we might find that it's harder to recruit new staff, new partners, because the PE investment enables firms to have greater capital to offer good packages to incoming partners to be able to get good market share. So that could be more challenging for firms that aren't PE backed. Likely we might lose people to those firms that have a bigger war chest of cash. Now, I'm not saying we definitely will, because some people might have perceptions that the culture in those firms is different, and the target driven nature of some of those firms doesn't appeal to them. But again, we need to be able to demonstrate, if we are choosing not to be PE backed, why we are different, how we can deliver something that appeals to them, that differentiates us, and it will be more than just money, I would have thought. We also have to think about the impact on clients, because we are all about clients, of course, in the professional services world. What do our clients think about us? Do our clients think that greater investment opportunity is useful to them? If they don't, then we'd think hard about whether we're doing it in the first place. But let's think about the market. It might be that PE-backed firms have a wider offering, meaning that our competitors now offer a one-stop shop, which could be appealing to some clients. They might be able to offer a different range of services. They might be more technology-driven. They might be able to offer more fixed fee offerings. Those sorts of things might appeal to clients in a slightly different way. And so we need to be really nimble to make sure we're continuing to compete effectively in those markets. So yeah, absolutely, if strategically that's the right thing, managing partners can choose not to go down the PE route, but I think we ignore it at our peril.
Corinne, so thank you so much. I really appreciate it. I feel inspired and informed, and I will take the call, I promise, now that we've had an initial chat about it, so that we can at least explore, as other firms are exploring, what the options are and whether or not it's something that would help us, like any other firm, on our growth journey. So thank you for staying with us. I hope you've enjoyed it. I hope you found it interesting and informative as well. Please do reach out to Corinne and also our partner Zulon Begum, who are spending a lot of time advising and thinking about these issues and helping firms to explore how to approach them. Also, you can check out the website where you'll find more information as well. But in the meantime, thank you again, Corinne. Thank you for watching, and hope to see you again soon. Thanks. Bye-bye.